Welcome to our inaugural event of Weekly Clippings. I am Lisa Abramowicz along with John Authers, and we're talking about the biggest stories in the market this week, as well as some of the perhaps most overplayed and underplayed risks in the market. John, great to see you. We both agreed on what the main topic was today. It was quite clear what the main markets issue was of the week.
Yes, it's inflation, as it has been.
Always inflation. I mean, come on, there's a nuance to it this time.
There is a nuance. There is a nuance to it, which is that we've just had the highest core inflation number in 29 years. And yet the bond market, which has been very frightened about inflation, so that we've been talking about little else for months anyway, basically went meh.
I think it did more than meh.
It fell after this shocking on the face of it inflation number that demands a lot of explanation.
Yeah, that not only did people look past it, but they said, we actually think that we might be heading into something that looks, I don't want to say disinflationary, but disinflationary potentially. I mean, otherwise, How do you explain a bond yield at 1.44% or 1.40% at a time when we are supposedly going to get incredible growth?
Yes, and I think, well, the basic answer is that you can't, other than that there is now a very strong belief. I don't quite understand how this has happened, that people actually are now inclined to believe Jay Powell when he says that he cares about unemployment and not so much about inflation, that there really is a belief they're going to keep sticking to their guns.
Do you buy that? Do you buy that if Jay Powell continues to buy $120 billion of bonds every month, that this is where 10-year Treasury yields should be, even with a core inflation rate that came in at the highest since what, 1993?
Yes. I think it might even have been. Personally, no. I am small c conservative, and this makes me very, very, very nervous. I'm not saying that there aren't plenty of good reasons why this could be transitory. Obviously, there are some extreme transitory phenomena contained within inflation. But to take this looks like such an outlier when you compare inflation both to bond yields and to equity valuations. Neither stocks nor bonds have ever looked, and we're talking about centuries of data here, looked through an inflation print this high to this extent. We're just so far out on a ledge that this is going to be transitory.
Well, some people say that actually equities are fairly pricing it, because if you take a look at where bond yields are, and if they're going to remain suppressed for a period of time, then their earnings look so much better. And on a risk-adjusted basis, they look so much better. And, there are data points to show that, and then there are data points that could potentially undermine it.
Well, both of us know there's data points to prove quite a lot of things if you really want to prove something. Yes, obviously, all other things equal, which economists love to say, all other things equal, lower bond yields justify higher equity value. Even so, however, we're talking now about long-term earnings ratios, or even forward earnings ratios, that are right up at levels that have never been seen before, other than right at the top of the boom, the dot-com boom in 2000, which implies that you are putting an immense amount of trust in bond yields to stay this low, which in turn, given that inflation is now at its highest in some decades, and there are all these very good reasons to believe, with the increase in money supply, with the demographic changes and so on, that we would be moving into a secular phase of higher inflation, that we're just putting an immense amount of trust in the central bank to go through with financial repression, to keeping these bond yields very, very low.
Okay, on the flip side, just to play devil's advocate, if you take a look at the CPI data that we got, it was actually pretty nuanced, because a significant portion of it did come from areas that you could just say is directly tied to the reopening. For example, car prices surging, right? Anyone who's tried to buy cars or car parts has been stuck by how exactly high everything is. That increase, I believe, accounted for about a third of the entire increase in the CPI print. So this is a very specific type of increase. Airplane fees, also, if you want to travel anywhere, you'll have noticed. Hotels, et cetera. I mean, these are the reopening trades. So how come we can say that that has a longer lasting feel, especially given all the extra debt that has been incurred, which typically is disinflationary?
Okay, well, plainly, yes, there are huge transitory effects going on here. Nobody can deny that. My own personal favorite, rental cars have literally doubled in 12 months. The cost price to rent a car.
I'm familiar, just lived it.
According to BLS. So yes, there plainly are transitory effects. That said, if you take a look at shelter, we're not going to go down the rabbit hole of the very complicated issues of how you account for shelter prices, rentals, and so on in CPI. It's gone up above 2%. It's edged up higher. Not in itself anything terribly scary, but we all know what's going on in the housing market at present. That is a cause for concern for the longer term. Beyond that, yes, if you take a look at the trimmed mean, when you remove the extremities, yes, you see inflation that is broadly under control. That you don't see the sharpness of the move. Again, it's just a question of how much confidence do you want to put in that to stay that way.
And so this brings us to this question of what the most overplayed or underplayed risk is.
Yes.
And probably until now, somebody could arguably have said that the most overplayed risk was inflation, right? Because all of a sudden you've seen a great unwind of that. And that's been sort of the takeaway over the past few months. Now, my question is at this point, what the most overrated or underrated risk is. I have one. We haven't shared it before.
Go for it.
You want to go first? You want to go first?
Ladies first. Go for it.
Oh, thank you. That's so kind of you. So I think the most underrated risk, actually, to sort of piggyback on what you were talking about, which is what is the message from the bond market? What if the bond market is not really responding to financial repression, but is responding to a much deteriorated outlook, say 6 to 12 months out, that maybe growth rates don't pick up quite as much, or they pick up and then they start to fall back pretty rapidly? And what happens if we're looking at a global slowdown that hasn't been priced in? And I'm not talking about, 2022, but maybe like at the end of 2022 or early 2023. And this is the prospect that's starting to be raised by a number of investors. I'm thinking of Jay Ploski from TPW, where he's basically saying, this could be a catalyst for a sell-off that would be coherent with the bond market. It could stay where it is, right? But all of a sudden, all of those PE ratios make that much less sense, right?
Yeah, I mean,
from the other perspective, which is way worse, because even it raises a question of the ammunition from the Federal Reserve. To me, it seems like I'm not hearing that very much, and therefore I think that that's the most underrated risk.
I think I have to say I think that's a very, it's probably a better candidate than the one I'd come up with.
Oh, you're not allowed to do that. Come on, stand behind your idea.
One of the other points I would make to support that argument is the extent to which the possibility of tax rises for next year has completely disappeared from the equation. I don't need to get too much into politics, but plainly in the short term, tax rises aren't great. And when you're building infrastructure, you probably do have to pay for it before you get the benefits from it. That's
I like the probably,
inherent.
Maybe.
And so this is an issue. There is a reason to think that we could actually get fiscal drag as soon as next year after this extraordinary fiscal boost in the last 12 months or so that's going to continue for a few more months yet. That it is a logical thing to fear that actually there are deflationary forces still out there, and that the very growth itself is transitory. So yes, I think that's. I agree with you that it's perhaps understated. I don't think I agree that that's really what bond markets are moving on. I think bond markets are moving on playing the Fed more than that. But I agree with you that that's a very good candidate for a most understated risk.
All right. And I could elaborate on that. And then, of course, there is the question of whether it's just a short squeeze. Okay. But what's your most underrated, overrated risk?
I think the most overrated risk, or the most overrated exciting development of the week is El Salvador adopting Bitcoin as a currency. The critical point I'd like to make about this, and I long ago I spent time based in Mexico, and I was responsible for covering El Salvador. I've been at El Salvador as a journalist once, and one of the nice things about that is you don't have to change your money, because the El Salvador dollarized. this is one of the key things that the reason you wouldn't want, as a government, as a central bank, to accept Bitcoin or to allow it to become legal tender is that means you lose control over your money supply. You don't have control over monetary policy. El Salvador bit that bullet 2 decades ago. Yes. Well, it's a wonderful and very sad, very tragic place in many ways, El Salvador. But there is a lot of crime. There's all this excitement about now El Salvador is going to set itself up as the crime capital of the world. That really isn't, I don't think, what the president is after. I can see how this might become more of a proof of concept for the passionate crypto backers, because there is this great need for the Salvadorans in the States to send money home, and they might be able to do it slightly more cheaply with Bitcoin. But I don't think that this is the huge development that it's been hyped as being. This is a very small country that still has very serious problems with disorder, that made a decision quite a long time ago to give up control over its own currency.
So you don't think it's going to necessarily be a huge boon to Bitcoin that El Salvador is adopting it?
Not really. I mean, it might mean that more Bitcoin enthusiasts go to El Salvador on vacation. Or I am not at this point. And it's a very nice place. They've got some lovely beaches on the Pacific.
Really?
But I really wouldn't. I've seen some very, very overblown, excited commentary about this from crypto enthusiasts. I'm not going to dismiss the whole crypto concept. There's obviously amazing technology in there, but the idea that this is as big a development as people are hyping, it just isn't there.
Okay, and then there's a question of whether there's an overrated or underrated opportunity. And I will say that the one deal that sticks out in my mind from the week is really Microstrategy's $500 million junk bond, with the proceeds going to buy Bitcoin, kind of piggybacking on your idea there.
Yes.
And the idea here is that this would not be backed by or collateralized by any existing Bitcoin holdings by MicroStrategy, but would go toward purchasing new ones at a very high price point. And this bond ended up paying 6.125%. It was actually came in well below where people had expected it to come in. And it was upsized by $100 million, incredible demand. But what you have seen is it is the worst performing new issue on the week in the high yield bond market. And that basically people are selling it because you're getting not that much upside, and you're getting a whole lot of downside potential. It's a very interesting deal, though. I mean, I personally don't. I mean, I'm Miss Gloom, but I don't know that this would be like my optimal area to go. But what it highlights to me is what people do for less than 6.25% yield. Yes,
I think actually that, not coincidentally, that was also so we are in perfect sync on this one, Lisa. It's very hard to look beyond this one. And when I was talking about overhyped crypto evangelists, there might have been some hype from crypto evangelists involved in MicroStrategy that was in my mind. Yes, just a little. Yes, where to start with this? The concept of raising money for something that doesn't exist yet is always a very alarming sign that some kind of a mania excitement is getting to the peak. If you read J.K. Galbraith writing about 1929, you had what were then known as investment trusts saying, "Give us some money in equity form, and then we'll do something with it. Honest, we will." You had the concept of .coms that didn't even have revenues yet going public, just over 20 years ago. This does feel, the SPAC phenomenon, can be. I have a lot of issues with SPACs, but they can be a little bit unfairly caricatured. They're a vehicle for doing a buyout, even if they involve, taking rather too much on trust and paying rather too much to the SPAC sponsors. But when it gets to this level, the amount of trust you're putting in MicroStrategy and the amount of trust you're putting in Bitcoin is very concerning, shall we say. And as you say, the degree of desire for yield is very concerning.
And it also raises questions about who is owning Bitcoin through something that looks very different than Bitcoin, and sort of the collateral damage should Bitcoin sell off. The idea of, leverage on top of leverage, and this lack of understanding of how far the exposure goes, which harkens back to another era.
Yeah, it's not as though you're going to get the next quadrupling of Bitcoin, but you will get hurt very much by the next halving of Bitcoin if you have this security. It's really not a great deal for you if you're buying it.
All right. Well, that's been the weekly clippings, and we will be back next week and do another weekly clippings. We're going to keep clipping all the main stories and hashing them out, and maybe we'll disagree sometime, but we'll see.